Hello, everyone. Thanks for joining in. My name is Sumit, and I'm co-founder of Truemind Capital Services. Truemind is a SEBI-registered investment management and advisory platform that offers unbiased, professional, and personalized investment advisory services. Before I begin the session, I would request everyone to keep your devices on mute. If you have any questions during the presentation, you can put that in the chat box, and we will answer all of the questions after the presentation. So it is very common knowledge that markets have corrected significantly. Indian indices are down by 16%. US indices are down by 20 to 30% from the peak level. Many stocks have corrected by about 50%. Sudden rise in yield resulted in also negative returns on long-term bonds. Speculative assets like crypto and NFT, they are down by more than 70 to 80%. Recently, Russia attacking Ukraine has created a lot of chaos in the market. There is a lot of confusion, and market is indecisive about the way forward. In this session, we are going to understand what future holds and how we can position our portfolio to take advantage of it. So before I discuss on the future prospect, just a quick recap to understand how we ended up here. So in 2007, 2008, after the subprime crisis, central banks all around the world started infusing global market with a lot of liquidity to support the growth and avoid recession. This high increment liquidity has supported all the asset classes over the last 12 years, 14 years, where US has been leading the entire central bank space with a lot of money printing. This excess liquidity and money printing, it accentuated a lot. The quantum increased significantly after corona-led lockdowns that happened all over the world, where, just to give you a sense, $10 trillion of liquidity has been infused by printing money in less than 2 years. US alone has doubled its balance sheet, Fed balance sheet size by from $4.5 trillion to roughly $8 to $8.5 trillion in less than 2 years. Not just increase in liquidity, but also supported by reduced interest rates, where many developed countries had negligible to negative interest rates, and still they are holding on the same levels. That also increased a lot of asset inflation across different asset classes, and also encouraged speculative activities. So asset prices across the board, from housing to equity market to bonds, all have gone up because of the easy monetary policy since 2008, which, as I said, after 2020, boosted all the asset prices because of excessive high liquidity that was infused by central banks. So you can see even for the housing, in the housing price index for US economy, the prices are way above the levels which were before the subprime crisis. And S&P 500 has gone up by 5 times from the bottom of subprime crisis. So stimulus checks and wealth effect resulted in significant increase in demand for goods and services, while supply side concerns that cropped up during corona-led lockdown were not completely addressed, and rather the attack of Russia on Ukraine choked the supply chains further. So this imbalance between demand and supply, that resulted in a rise in commodity prices, which are commonly used. So the commodity prices across, gas, crude, wheat, corn, cotton, they have doubled from the levels which were before corona-led lockdown. Now, inflation has started becoming a major headache for the government. Recent survey indicated that inflation is the biggest concern in US. And it is really not desirable for political establishment. All the administration, political establishment, they want to maintain popularity and do not want to destabilize their government. And they are therefore just forced to act upon in a manner to increase interest rates and reduce inflation somehow. there is an eerie similarity of what is happening now and what happened in 1970s. In 1971, the Bretton Woods system, which was essentially linking the printing of US dollar with the production of gold, that was completely abolished. It was followed by sudden rise in oil prices. There was an oil crisis because of Saudi Arabia and other countries not supplying oil to the world in response to some war-related activities. The oil prices jumped from $3 per barrel to $12 per barrel in quick succession, which resulted in an entire era of high inflation. So the decade of 1970s to 1980s saw a significant, period of high inflation. Although the government was taking steps, they were increasing interest rates, but not enough to reduce the inflationary expectation. By the end of 1970s decade, in 1980s around, the interest rates were increased to about 20% to engineer a recession in order to reduce inflation and inflationary expectation. Equity market during the period declined by about 50%. Right now, we have seen easy monetary policy because of corona-led lockdown and also low inflationary environment has encouraged government to print more and more, and balance sheet size doubling all across the developed economies, increasing significantly. Russia-Ukraine conflict followed after that. Russia-Ukraine conflict that also resulted in supply issues on the crude side that that resulted in increasing the crude prices and resulted in outcome which we are still not sure how it will end up. We are seeing increase in interest rates right now, which has caused some decline in the asset prices. But the way forward is very tricky. The solution is simple. To reduce inflation and inflationary expectation, you should increase interest rates. But the problem is that the world right now is highly indebted. The global debt to GDP ratio is multi-decades high, and most of the debt has been issued after 2020 in easy monetary policy scenario when the interest rates were at a very, very low level. So one can understand if the interest rates are supposed to increase now, the ability to service the debt portion is very low. There could be massive defaults going forward. So right now, the US economy, developed economies, they are really in the hard place, a rock and hard place. So there is not an easy way out. You cannot just increase interest rates and can lead to severe defaults in debt side, which could lead to a very deep recession from which coming out could become very difficult. So there are three possible scenarios which we could think of going forward. First scenario being US led, Fed in US, they lead the increase in interest rates in quick succession and dampen the demand, attack on the demand side to reduce the inflationary expectation as well as inflation. Second scenario is they do not take very extreme steps. They continue to manage somehow by increasing bits and pieces of interest rates going forward, and hope that inflation will eventually taper out. Third scenario could be inflation comes back to normal on its own on the back of miraculous easing of supply side concerns. So let's see how the scenario could pan out and what would be the outcome. So first being a sharp increase in interest rates in quick succession, where if they have learned the lessons from 1970s, 80s decade, they would know that unless they increase interest rates significantly higher than the inflation rate, inflation is not probably be controlled, and there would be a long period of high inflation. So in that manner, they can actually increase the interest rates and lead to a mild to a severe recession in the economy, which will curb the inflationary expectation. And then the economy, once normalized, it can continue to run on its normal course. The probability of that happening is medium to high. As I said, it could lead to mild to severe recession. The impact on different asset classes could be a major correction in equity, where bear market sustaining for a year at least, where the markets understand that things have corrected and they can continue their upward journey afterwards. On the debt side, there could be huge mark-to-market losses, especially on the longer duration debt. So it's very important that one should not be having a portfolio in long-term debt. Any investment in long-term debt should not be done right now, especially in an environment where interest rates are expected to go up. So don't lock up your investment in debt, which in a longer term debt at a lower yield. Gold, it can go down a bit because if the debt yields start going up, money will start flowing to the debt side, which is yielding something. Gold would not be much in favor because inflation will go down unless there is a significant geopolitical concern or escalation of tensions all around the world. Then gold will continue to remain in favor. Second scenario being this is the high probability scenario, which we think primarily, as I said, because of excessive debt levels. There is a possibility that they will chicken out in increasing the interest rates to a level which is required to lead to a recessionary scenario. Although a piecemeal increase in interest rates going forward could also lead to slowdown to recession in the US economy. And what we have seen recently from the commentary of central banks, especially in US, they're saying they will increase the interest rate till the inflation doesn't go down below the nominal interest rates. Although the statement has been said in quite a confidence, but we have earlier also seen the instances of reversal of what they say and what they do. So there is always a doubt in the market that if the equity markets will correct significantly, then the central banks may reverse the course. So what will happen in this scenario? There could be a gradual and frustrating correction on the downside over a longer period of time. Bear market can sustain again for a longer period, where the prices will remain in the range bound or maybe slightly going down, which could be a very frustrating situation to be in. Debt instruments will see some low mark-to-market losses. As I said, long-term debt papers or instruments should be avoided because they will continue to face pressure. Gold will gain, it will become more attractive if the inflation will continue to remain high above the nominal interest rates. And any geopolitical concern will further increase the demand for gold. The third scenario, which it seems having a very low probability, where inflation just comes down on its own, central banks hoping it really works out. There is a small possibility of that happening, but a very low possibility given that the supply side concerns are not going to solve on its own. It will take time. The investments in building capacity has been very low over the last many years. Globalization also encouraged low inflation environment. And now we are talking about deglobalization. We're talking about diversifying our manufacturing plants away from China and in some other countries as well. So there are some factors in place, and obviously, the excessive liquidity, it has to settle down somewhere. So unless, there is some miracle, this scenario seems quite less probabilistic. The impact on equity, again, if that happens, then obviously equity markets will be very pleased with it and will continue to see elevated levels and further increase in equity returns. Debt market would also see mark-to-market gains because interest rates, as expected, they are going to go up right now, discounted all across the debt instruments. The interest rates again will come down on its own, and the long-term debts would be benefited from this. Gold would be lackluster, as one can really understand, if the inflation is low, geopolitical concerns are not escalating, gold will lose its luster. So whatever the scenario that we ultimately end up in, reversion to the mean, it's important to understand that reversion to the mean is the iron rule of the financial market. So something which has gone much above the mean will go much below the mean as well, so that in long term, the mean is maintained. What we have seen over the last 2.5 decades, there has been cycles, which can be seen from how the Sensex trailing PE multiple has performed. We have seen cycle in terms of PE multiple, where the PE ratio on the peak of the cycle has gone above 30 times. During IT bubble in 2000, it has gone to 28, 30 times before subprime crisis, and it has gone above 30, 35 just last year just in November 2021. And during all these peaks, we have seen the behavior of people almost similar, where the speculation is very high, greed is very high, there is a euphoria all around, and the feeling that nothing can go wrong, it is the feeling which drives most of the market participants. And the fact is, after every such peak and after every such behavior, there always has been a major decline in the market eventually. The markets corrected to about 12 to 10 P on the downside, which is a correction of 50 to 60% from the peak. This time, whether we will see a decline of 50 to 60%, again, it's very difficult to say. But if we look at the previous market behavior, there is a possibility. So what should be the investment strategy to deal with any possible scenario? We talked about 3 scenarios, but there could be 4th or 5th, which we cannot think right now, but it can crop up. And so there could be multiple scenarios, and how we then should prepare our portfolio, because preparing our portfolio for any future outcome should be based on possibilities and not certainties. Markets are highly uncertain, world is uncertain, so no investment strategy should be based on certainty. It should always be based on possibilities and probabilities. So idea is simple. You reduce your equity exposure when equity valuation goes up much above the long-term average, and increase equity exposure when equity valuation comes down. And how do you do it in a disciplined manner? You prepare a tactical asset allocation plan which is suitable to your risk profile. So this is just a sample reference for a tactical asset allocation of an investor having moderate risk profile. So what we have done here is we have assumed, or based on the historical data, 18 to 21 is considered to be a fair valuation, long-term fair valuation. Long-term mean for Sensex is about 20 times, for Nifty is about 21 times. So 18 to 21 is considered to be a fair valuation range, where we can have equity allocation in the range of 50 to 60% and remaining being in debt. And yes, gold also has to be an important part of the portfolio right now, unless the geopolitical concerns go away completely and inflation comes down, meaningfully. So when the equity, when we are also, seeing the TTM trailing 12 months, your last 12 months, how the P ratio is, and then deciding what should be the equity allocation, what should be the debt allocation. When the equity P ratio equity market P ratio is going above the long-term average, then the equity exposure in the portfolio is reduced gradually. So this way we are just, going against the common behavior where people become more greedy and they increase their equity exposure. In this scenario, we really have to reduce our equity exposure. On the contrary, when the equity markets are going down, when the Sensex P ratio is going down, we should be increasing our equity exposure. And what happens when the markets correct? Many people just don't participate, or they, become long-term investor thinking, okay, when the prices will come back to the levels which they have purchased, they then will probably, take it out. And when the panic is very high at the bottom, then many people end up taking out money, thinking that there would be further decline, further losses going forward. And so that is something which a significant or major mistake people end up doing, buying at high and selling it low. We have to, really, if we really want to be successful in our investment strategies, investment outcome, then we have to do a counter cyclical approach towards investment management. When the Sensex P is going down, we should be increasing equity allocation. It requires a lot of courage because a lot of people are, taking out money. There is a lot of fear in the market, panic. But whoever is able to do this activity of increasing equity allocation when the markets are down, end up gaining significant returns when the cycle turns up again. So it's a fact that there has been cycles in the past. The cycles will continue in the future. So one has to really understand this fact, stick with the asset allocation plan, invest more when the markets are, when there's a blood in the market, and reduce when there's a lot of greed in the market. That's the only simple way of making great returns at low risk. Although it's simple but not easy to do, that's where your investment behavior would matter a lot. How you behave during market volatility. So a lot of us know that in the last 12 years, in the last 20 years, the markets have delivered 12% CAGR, and we end up thinking, okay, the 12% CAGR is something which will happen every year. So it would be like 12% every year. It would be will not have much volatility, even though it would be some volatility. But 12% CAGR gives a misleading picture that markets have delivered 12% every year. But in reality, the markets have been very, has seen a lot of extremes, very where the upside also has been very high, downside also has been very high. And if you see at the bottom here, from 2001 onwards, the markets have seen very high returns in a year of about 70% and 100% in last year, and a decline of 50%, 35, 40% in a year. So this is something which is part and parcel of the entire process. You have to take any negative returns or any decline in the market in your stride. You have to understand it's a part of the process, that you will see negative returns over a period of time to be able to generate great returns in the long term. And what you really need to do is, when the markets have gone down, corrected significantly, you should be adding more money towards equity. That will bring down your overall price of buying further, bring down the price of buying. And when the cycles will reverse, you will end up gaining significant, you will see significant returns on your portfolio. So as wise people say, the path to nirvana goes through a very difficult terrain. One has to keep that in mind. One has to understand that negative returns are good part of the market, where it gives you opportunity to invest at lower levels, and be patient with the market recovery, and then only you would be able to make successfully high returns. Thank you. So anyone having any questions, please put that in the chat box. We can answer them now. So Anand is asking, any thoughts on real estate? So real estate, usually, the factors which influence real estate prices are usually low interest rates and high income growth. In US, Australia, UK, in developed economies, we have been seeing a significant increase in real estate prices already. Increase in interest rates would lead to a sharp correction. Probably will, the next asset class which economists are talking about, which will see a significant correction, is real estate in developed economies. In India, the prices of real estate didn't go high as much because they were already very high from the starting, and they have seen a good uptake in the last 1 or 2 year time frame. and a lot of people, they decided to purchase a house by taking EMI at interest rate of 6.7%, 6.8%, which is not the case anymore. Interest rates have started going up. The economic slowdown is appearing to be, getting in place, and there is a possibility that more job losses will happen. The comfort regarding future prospect is somewhat, it has somewhat disturbed. So I do not see the end demand in real estate will continue to remain as high as it was in the last year. We may see, some low returns, or maybe, maybe negative returns going forward in real estate. Although it's also, it has been said that inflation, real estate is a good hedge for inflation. But in a scenario when the real estate prices are already very high, the possibility of gaining much from the real estate is something which I think is not a possibility in the current environment. Next question is, which sector would be most impacted during slowdown? That's an interesting question. The sectors which are dependent on discretionary spend and sectors which are high beta, which are related to interest rate movement, they get impacted during a slowdown. So just to give you an example, banking sector is something which I think is a high beta sector. If the economy goes through a recession or a slowdown, banking sector will see a significant downside. First, the demand for loans will go down. Second, the NPAs will go up. So banking sector is something which I would not be overexposed in the current scenario. Another sector being IT sector, which has already seen a significant jump in the valuations. It is mostly dependent on discretionary spend. So that is another sector which I would not be too bullish in the current scenario. Auto, again, being a high beta sector, although the valuations are not too expensive, and one can be, can be little bullish on it, but still how it will pan out, it's very difficult to say. The idea is one should stay away from any sectors which are high beta, and that also includes commodity sector. Current Sensex P is at around 21.5 times, which is again higher than the long-term average. Although much better than what we have seen last year, it went up to 30 times, more than 30 times. It has corrected a bit, but as I said, something which has gone much above the mean, there is a possibility to go much below the mean as well, so that in long term the mean is maintained. So although there is a comfort level at 21.5 P, but if the cycle is reversing, then the possibility of downside is around 40 to 50% maximum. It's a possibility, not a certainty, but 40 to 50% downside maximum could be a scenario which we can see. Since we cannot be certain of it, that's why equity exposure has to be in such a way that the maximum downside we can see on our portfolio, which you can bear on our portfolio. That's how the overall asset allocation should be designed. Knowing that you would be adding more in equity as the markets will continue to. So someone is asking, Arpit is asking, should we invest in the market or we should keep our money in the bank account? Keeping money in bank account would not serve any purpose if you really want to create better returns, better than the inflation rate. Inflation is already very high. We are, whatever the government numbers are, we are experiencing 10% plus inflation right now. So it's very important that some exposure to equity should always be there in the portfolio. As I said, we cannot be certain on the downside and think that we should, have a 0% exposure in equity. That is really not the right approach. Approach is you should decide the range of your equity exposure in the portfolio. And when the times are, when the markets are too expensive, that is the right time to reduce your equity exposure. And when there's already a fear in the market, you should be slightly increasing your equity exposure because the downside risk is already, low compared to what it was earlier. So that's where, the deciding on the range would really help you generate better returns. managing your asset allocation within that range. When the markets are low, increase your equity exposure. When the markets are expensive, valuations are high, reduce your equity exposure. That's how you would be able to reduce the downside on your portfolio and take advantage of low equity valuation by moving money from debt to equity at lower valuation and get good returns at low. Shivansh is asking, what about current volatility in current market and what is best for small retail investors in current time? So volatility definitely is high, more so whenever there is any news on increase in interest rates, increase in inflation. So volatility, what we'll see right now, going forward would be much higher than what we have seen earlier. Thanks to the central bank liquidity support over the last 12-14 years, before subprime, there has been very less volatility in the equity market. And this has probably, made a lot of investors think that markets do not go through a significant volatility. They probably had formed a misconception about market volatility. In reality, there is a lot of volatility in the market. The correction of 20% is very normal in any year, which didn't happen over the last 12 years before Corona led lockdown. As I said, because of the central bank benevolence. And going forward, the similar situation is not going to happen. The liquidity is not going to support the market much unless inflation comes down on its own. We'll see significant more volatility going forward. But this volatility is really good because you will get to see equity prices which are more affordable and be able to take advantage of low equity prices by investing in them for long term. Priyank is asking, are there sectors which should be avoided and sectors to be focused on in current market? The sectors which should be avoided, I have already explained, the high beta sectors like banking, auto, commodity, even IT sector. These sectors should be avoided. Maybe the exposure should be reduced. One cannot completely avoid it if you're investing in a mutual fund. The sectors which one can focus, I would say value-oriented sectors which didn't participate in the last many years. So maybe energy sector could be one, a pharma sector which didn't, see a good overall returns in the last 1 year. So these are the sectors, I would rather be investing equity portion in large cap focused, value oriented portfolios. So, they are value oriented fund managers, value focused, they are growth focused fund managers. Most of the industry, most of the fund managers in the industry are, in the mutual fund industry are growth focused, where they would invest in any good business, in a good business at any price. So even if the P ratios are, significantly higher than what they were in the past. For example, Asian Paint would be at say 80 plus P ratio, Nestle, Pidilite, Page Industry. They are at a very, insane valuation. So many portfolios benefited from such stocks earlier because no one was really bothered about valuation. But I do not think that they will continue to enjoy good returns, these stocks, particularly high P stocks going forward. So it's better to stick to portfolios which have lower P and which are value oriented and sectors like, energy, pharma, where the exposure of energy pharma sector is higher. So Arpit is asking, as interest rates in FD are increasing? Yes, certainly. The interest rates have gone up. They have been increased by all the major banks recently in the last few days, but not as much as the increase in repo rate done by RBI because of still excess liquidity in the system, which needs to go away. Sham is asking, is there more chances of more correction in market going forward? Certainly, I mean, there's always a possibility of higher correction in the market. There's never a certainty. I would never, talk about anything in certainty. It's about the possibility. Yes, the possibility of going down is higher, But possibility of going up is there. That's how you have to you have to design your asset allocation, keeping in mind the possibilities and the maximum downside you can bear on your portfolio. So idea is you should know that P ratios for P ratio for any index, for example Sensex, the lowest had been 10 to 12 times in the past. The maximum it has gone to 30 plus. So it is a range that one needs to look at and create an asset allocation within that range, knowing that there is a possibility, there is a, even if it's very low, that Sensex can go down to 10 to 12 P. Then how would you react with the negative returns on your portfolio? How much comfortable you are to the levels of decline in your portfolio? So the level to which you are comfortable, even when the markets are at 10 to 12 P, that's how the asset allocation should be done. So that even if it is at 10 to 12, the decline in your portfolio, if you're comfortable with 20% decline, it should not cross 20% correction in your portfolio. That's how the asset allocation needs to be done. Abhishek is asking, is it the right time to invest in gold? Well, if we have to see scenario 1 and scenario 2, where geopolitical concerns are still high and they can escalate, inflation is still not under control, I think having 15 to 20% allocation of your portfolio in gold makes sense. It should be seen as an insurance against any global turmoil. It should not be seen as a way to make returns. So in case something really unexpected, something really ugly happens on the world stage, then gold will come to the rescue of the entire portfolio. That's why having allocation of 15 to 20% in gold is highly recommended. The sectors I have already discussed about. Sham is asking, how many stocks should one have in ideal portfolio? See, if I have to create a stock portfolio, the number of stocks should not be more than 20. But again, within those 20 stocks, how much allocation should be there for which sector, that needs to be decided. How much allocation within that sector, how much allocation should be of a particular stock, that needs to be decided. And it's a very scientific approach towards building a portfolio, which I think a fund manager can do a better job than people who have no core expertise in managing investments. Manshi is asking, is it good analogy to say that interest rates are directly proportional to exposure in equity to reduce your overall equity purchase price and would give you high returns once market corrects? So thing is that when they are also there have been periods where the increase in interest rates have gone hand in hand with increase in equity prices. But those scenarios are completely different, where the market started going up from a very low valuation in the cycle. And what we are seeing currently is very different, where the markets are already elevated, valuations are already very high. So increase in interest rates will result in a correction in equity market, which eventually happens even during all the cycles. Whenever the equity markets have gone up, interest rates have gone up to a level where it is not sustainable for equity market to continue to see a higher returns, because businesses start getting impacted. Something during subprime, the debt serviceability capability, or increase in asset prices of home prices, that stopped happening. So that caused a massive decline in the equity market. So as I said, when the equity market, one just should be having an asset allocation based on how much equity valuation is at current level, and not much think about where the market will go. One should anyway have an asset allocation based on your risk profile. One cannot predict future, so that's how the probabilities is something which we should be assigning to our portfolios based on the risk profile. Lehana is asking, so everything depend on how fast the mop up of liquidity happen by regulators. Certainly, if the liquidity, the reduction in liquidity and increase in, by manner of increase in interest rates, or by, not issuing the debt further, or rather sucking out the excess liquidity from the system in a very aggressive manner, then certainly we will see a sharp decline in equity market. If the quantum of liquidity reduction in the system is not very high in a short period of time, then we'll see, range bound equity market with a bias on the downside. So what are the good indicators on this speed? Certainly we should keep watching the Fed announcement on interest rate. They recently increased their key interest rate from 1% to 1.75%. The talks of further increase of 0.75% is already underway, which is expected to happen in July. So this is something which we need to watch out for. We also need to understand the commentary of Fed Chair Powell, what he's talking about the interest rate scenario and inflationary expectation going forward, and the impact on economy. So a lot of things comes from the commentary. One can understand from the commentary as well how serious and serious they are about reducing the inflation. Having said that, there have been instances where they have completely taken a U-turn. So it's very difficult to really say what they will end up doing. So leading indicator would certainly be watching out the Fed size of the Fed balance sheet, to see whether it's increasing or whether it's decreasing, at what pace it's going up or going down. And then what central banks in Europe are doing, central banks in UK, Australia, Japan, they are doing. We are very much intertwined with what's happening in the global economy. So whatever impact on global economy will be, it will also have on India as well. Although we are still much better than other global economies, given the level of debt to GDP is not as high as it is in developed economies, but still the concerns are higher. It has gone up. Debt to GDP has gone up. Our fiscal deficit is at 6.4%. Can expected to be 6.4% for this financial year, but can go more than 7%, which is a matter of concern. This will increase our debt servicing capability, our debt payout for interest payout on the debt that we are having, which will further erode our fiscal deficit. Arpit is asking what should be the ideal asset allocation percentage wise in equity, debt, bank FDs. Bank FDs currently, because I think when markets will be correcting, or at every down in market by 10%, we can increase our equity exposure. So equity exposure can be increased by shifting money from debt mutual fund to equity as well. So having money parked in ultra short-term money market debt funds would be the right thing to do in an increasing interest rate environment. Allocation of your investment portfolio investment across equity, debt, gold is completely dependent upon your risk profile and the market level, as well as the direction of the market cycle. So what we think the direction right now most probably is going from peak to bottom. Again, not certainty, but there is a possibility, a higher possibility. That's how the asset allocation plan is designed. And it has to follow. You really need to work on what is the maximum downside you can see on your portfolio. If you need any more help, you can get in touch with us. So Sudha Seni, she's saying that there are multiple articles indicating onset of bear market. What's your take on it? Certainly, if the central banks all around the world have to curb the inflation and inflationary expectation, they will have to increase the interest rates, which have led to recession many times in the past. So every time there has been increase in interest rates, the recession has followed. And yes, when we were seeing the inflation will continue to go high, commodity prices were going up on a continuous basis. But in the past 1 week time, the commodity prices are also going down. because the market is now expecting a recession, which will result in correction in equity prices. So again, as I said, the expectation is of recession. What will happen? It's very difficult to, say with certainty. Yes, the possibility is higher, and accordingly, the asset allocation plan should. So I think I answered most of the questions. Okay, so Abhinav Jain is asking, what are the chances of recession in India within a couple of years? Okay, it's so the recession in India, the possibility is very low, but slowdown, certainly there could be a slowdown going forward. Our economy is also very much dependent on how the global economy is playing out. If there is reduction in liquidity on the global level, we will see lower FDI flow, we'll see lower FII flow. Rather, FII flow has been negative for the past many months, and we'll see that continuing going forward. And that's where the possibility of slowdown seems higher, but recession seems, a distant possibility, given we have some factors like young population, consumption-driven economy, now high forex reserves. So there are some factors which probably will help us, not get into a recessionary environment. But hope so it doesn't happen, but still one cannot be sure of. So Sneak Jyoti is asking, shall we move some allocation from small cap to large cap, or newer investment more on large cap than mid small cap? If you have a portfolio, a sizable portfolio, then I would surely recommend that you move your investment towards large cap, do not keep much exposure in small and mid cap. But if you are running SIPs, then that is something I would say you let it happen, because SIPs are, they are designed, the purpose of SIP is to benefit over the cycle of the market. And it is usually for 5-year plus period. So SIP is going in small and mid cap, some portion of your overall SIP portfolio, it should not be a problem. So a recession, Mohit sir is saying that we need to have common definition of recession here. The recession, probably, what you should be aware of is technically it is 2 quarters of negative GDP growth rate. In US, last quarter, we have seen a negative GDP growth rate. And in this quarter, although the expectation in the beginning of the quarter was positive GDP growth, but by the end of this month, by 15th June, now it is of 0% growth. I mean, they're talking about no growth in GDP. And there's a possibility by the end of the month, we may see a number, the expectation of negative GDP. So that would technically qualify US in recession. And that is something which, as I said, is a distant possibility in India, but a lot of developed economies can see a phase of recession where recession could last for many quarters. And the consensus is that 2023 will see a recession. But the fact is that the recession could be here right now in US. But how, the curve will go, the GDP growth will pan out from here. Very difficult to estimate, given there are so many moving parts around. So the only way to deal with the current scenario and future, outcome is to have an asset allocation plan, have a discipline to, stick to your asset allocation plan. And if you are able to execute your asset allocation plan well in time, by keeping your emotions aside, you will end up getting great returns when the cycle will reverse. So I guess all the questions have been answered. We can then move to close the session. Thank you everyone for your time and taking out time on the weekend and listening to me. Thanks a lot again. And if you have any questions, so you can reach out to us. We'll help to solve them with best of our capability.